What is the Fed? Who are these people? How are they picked? How do they make decisions? Have they been more right than wrong, more wrong than right? Are they fixing the economy? Are they harming the economy? Are they the solution? Are they the problem? These are all questions that I have often grappled with as I try to cover economic policy in this country. And to help me answer those questions, I'm excited to welcome on Rob Copeland, who's a reporter for the New York Times. He writes all about all things financial, the banks, the Fed, et cetera. He also wrote this excellent book called The Fund, all about Ray Dalio, this sort of famous hedge fund leader. And in this interview, I get into it with Rob, and I try to ask like the simple questions that often I felt like embarrassed to ask. But I'm like, all right, like, why do things work this way? Should they work this way? Should we think about things differently? If you care about the Fed, which you should because it affects your life, I think you'll find this really interesting. Let's jump in. All right. Well, I'm excited to welcome back Rob Copeland, who we had on earlier last year, all about his book about Ray Dalio. And Rob, you're still alive. I'm glad we have a proof of life here. He hasn't come for you yet.
This is the AI, actually.
Yeah.
Doing the best impressions of me.
That was a very popular interview. A lot of my friends wound up picking up the book and, were similarly horrified. But I just saw that you tweeted or retweeted something about Ray Dalio and Diddy. What's going on between these two guys? He deleted some kind of interview he did with Diddy.
Oh, this is just perfect, Ray Dalio. He, in 2019, at sort of the peak of his trying to become a international celebrity, he claimed to be Diddy's mentor. And he went so far as to tweet and post on LinkedIn and everything that Diddy was a hero of his. And so, of course, this being Ray Dalio, instead of responding to requests for comment on whether he knew about any of the accusation against Diddy, he just deleted it all and won't say anything. It's great.
Yeah, it's like the Usher, something happened with Usher over the weekend. I haven't quite devoted the time to it, but he apparently, he claims he was hacked, but all of his social media disappeared at one point over the weekend and then reappeared. And his relationship with Diddy was more complicated, but
I would read that book. I would, if anyone listening would like to write that book, I will pre-order it. There were some crazy things going on there.
I actually think after your experience writing The Fund, you could probably tackle Diddy's universe. Somebody's going to write that book, given the amount of NDAs and all these kinds of impenetrable financial arrangements that you had trying to write your book. I feel like your skill set would probably be useful for a Diddy book.
You know what's fascinating, by the way, is that Jeffrey Epstein, who I could talk about Jeffrey Epstein for, days, and anyone who thinks that he killed himself in that prison, well, I'll give you my opinion at a bar after 2 beers. None of the Jeffrey Epstein books really did well. It was people didn't actually want to spend 12 hours of their life having to experience what happened to those women and girls. So it's actually a really interesting writing challenge because you can't just say, okay, go through all the accusations against Diddy. In a way, you have to humanize him because we're all humans.
Yeah, I actually interviewed Bob Spitz, who wrote books about the Beatles, Led Zeppelin, Dylan, and all that. And he said when he was writing the book about Zeppelin, he basically picked a few examples of them sleeping with underage girls because he felt like the book would be unreadable if he focused exclusively on that element of who Led Zeppelin was. And I think in that sense, probably a good Diddy book would go through the entirety of his complicated history, like his business relationships, his work with B.I.G. and all these people in the 90s, et cetera, his relationship with Lopez. I imagine that would be a very hard book to read, but if it was done right, it could be, very compelling.
Super high impact. And unlike me, who got threatened with so many law firms and lawsuits, I mean, yeah. Diddy could threaten a reporter at this point, but he's been charged. So the public interest is so high that I'm not even sure it would be a good use of his money.
Well, one of the pieces of speculation is that he tried to, he committed arson against Kid Cudi, and there's all sorts of rumors about things that he did well beyond that. And so it'll be interesting to see what comes out of that. I live in Brooklyn, and I pass by the detention center that currently houses SBF and Diddy, who apparently are sharing the same public space, which is really a sense of how things can change really fast in this world.
That's a buddy comedy. I would watch it.
Yeah, we'll see. You'll see what happens to those two. But you have been covering the Fed. That was the worst transition ever, by the way.
Let's go from Diddy straight to the Fed. That'll
Fed.
do it. That's an Emmy award-winning.
I wanted to bring you on because I just want you to help demystify what's going on here. As a starting point, help us understand for the audience, like, who is the Fed? Like, what is this entity? How are they appointed? And what's their jurisdiction?
So I would just to say to start is my colleague Gina Smolik, who's our Fed reporter, is a truly incredible person who wrote a book about this topic. So I'll do my absolute best. I cover it with her, but she's very much she's a true genius. If you think about the U.S. government, how it funds its everyday, how we build roads, how we have prisons like where Diddy is, how we pay for our military. It's not that we have the money every day and we pay for it. We as a society, we borrow the money. So at its core, what the Fed does is it's a central bank for the United States government. And it helps the United States government borrow money to fund all of our lives, everything that government does.
And so, you wrote this article with your colleagues about the sort of coming rate decision that happened last week, where I think they went on the sort of more bullish side of things, and we'll get to what that means in practice for the economy. But I think a question I often get from our audience is, like, why not just have one consistent rate? Like, why do they keep fidgeting with the rate? And is their track record even good with fidgeting with the rate? Are they doing more harm than good?
So that's a very fair question. And I'll give you the least boring answer for this, which is that for much of the history of the United States and most countries, in fact, the dollar or the currency was actually worth something that you could exchange it for. So it used to be worth an amount of gold. So the dollar gave you a certain amount of gold, and it could have been silver in some countries, but there was I don't want to say real, but there was something behind it. And about 50 years ago, for reasons we won't get into, the United States realized that it was actually more advantageous to just have it backed by what is called the full faith and credit of the U.S. government. You cannot go into a bank, give them $1, and get back anything in return, right? You can only get the good and service. You can't get a gold bar or anything. So as part of that, there needs to be a complicated management system for how you figure out what the dollar is worth. Because it is not worth anything in particular, it means that every single day when you walk into your laundromat, they could charge you a different amount. They could, your employer could pay you $1, and you say, well, how do I know how much this is actually worth today? So the Fed sets interest rates to basically even out all of these, what it's called its dual mandate, which is to keep the labor market steady and to keep inflation, the price of goods, from going out of whack. If they could do that without ever changing rates, they would, but that's impossible.
Yeah, or at least, like, the sort of counterfactual I've always wondered is, what if they just set the rate, like let's say this time they set the rate at 3%, like at the end of this process, or 4%, right? And they just said, all right, we are just going to leave it that way. What would happen? Like, I could say from the consumer side of things, it would be helpful for everyday people who are just trying to predict, can I buy a home today versus tomorrow? I think for the average person, they're really frustrated because they're like, a good example is where we are right now. It's like, all right, I want to buy a house for my own reasons, and the right house down the block became available, but I have the sense that the rate is going to continue to go down. But I don't really know whether the rate's going to go down. Like, if inflation pops back up again, it will go back up, and I'm kind of at the whims of just these people who I don't really know who they are or how they're appointed to make that decision. But if I just knew what the rate was going to be, then I could plan my life. The counter to that, the counter to that is obviously like if they aren't able to change the rates, maybe we are more likely to see recessions and depressions.
So you brought up three really interesting things there. I think one is really important is that you actually do know who these people are. The Fed Reserve Board is appointed by the president, and they are appointed intentionally on terms that overlap. They don't go strictly when whoever wins this election doesn't get to fire the Fed Reserve Board and appoints all new people.
Yeah, so, Trump has like threatened similar things along these lines, but we can get to like whether he has the power to actually do that.
Sure, but let's take it just for the purpose of argument that we do elect these people. We elect the president, and the president appoints, and over time the board changes. Now, for most of the history of the Federal Reserve, it was as apolitical as you sort of can expect. I'm sure an eagle-eyed listener would find me lots of examples, but it was pretty pure, honestly. And so the general argument you're making about why don't they just do this very simple thing, it reminds me of an argument that you'll hear a lot of politicians make, which is let's just raise, for instance, why don't we just raise the minimum wage? Everyone will make more money. But the economy is very complicated. Everything is interconnected, and you can't just raise the minimum wage and think that everything is perfect. In fact, that has a lot of unintended consequences, which may be positive or negative depending on how you look at it. And it's the same thing with the Fed. Let's say, for your example, it was 3%. Who cares? Let's say they left it at 3%. We know that the economy goes through cycles. There are hot times and cold times. Even you go into work everyone knows, right? Stock market goes up, stock market goes down. If they left the rates at 3%, what would happen when the economy got super, super hot? When everything was going gangbusters, when rents were going up really high, because everyone's got a lot of money, and Rolexes, like they were 2 years ago, where all of a sudden every bro in Brooklyn was buying a $20,000, 20-year-old Rolex they didn't even know that they liked anymore. If the Fed, the mechanism, the way the Fed has to fight that super hot economy is to raise rates. But by raising rates, it means that the interest that you earn on your savings as opposed to spending goes up. So that provides an incentive for you not to go out and buy that Rolex.
And so, on this front, the counter to that is, well, is the Fed the solution or the cause of the problem? And the sort of the people who believe in that argument will point to the pre-pandemic era where the Fed was keeping rates lower than I think a lot of people in hindsight felt like they should have. In part, this gets to your sort of eagle-eyed listener and the politics of it. Like there's a lot of accusation that they were, bowing to pressure from Trump to keep the rates low and all that, and that was a critical factor that, combined with the pandemic, brought us to this sort of unprecedented, at least in my lifetime, inflation. And then there's like, obviously, that you go all the way back to the 90s, there's this sense that Greenspan mismanaged the interest rates in the late 90s, which may have been a factor in that recession as well. Do you buy into any of that?
I think even the world's biggest Fed fan, and there aren't many anymore, would say that they're always wrong. There is no perfection here. There's no way to always get it. They'll always get it right. I would say the vast majority of economists and of just smart dudes, honestly, and women who look at this do believe that having Fed rates that can change is the best thing for the economy and for all of us. I'm not a defender of the Fed, so I'm not being paid to defend the Fed. But the U.S. does have the strongest economy in the world. We are the envy of the world, and you can give a lot of credit of that to the Fed, which controls interest rates, which are the most important single data point for the economy.
And so right now, I think most people felt like this Fed was not going to be able to achieve what's called like a soft landing, which is to get inflation under control. This could not be the technical definition, but my sense of it is to get inflation under control without triggering a recession. Is that roughly what a soft landing means?
Well, I would challenge you on something. Who the hell are most people?
Well, I meant like I guess like there's all these polls of economists, J.P.
Right.
Morgan, Goldman Sachs, who are giving these probabilities that were like 99%, 90%, recession, risk, or probability of a recession
All those people
2 years
should,
ago.
all these people who make their living telling you exactly what's going to happen next should walk directly into the East River. Like, I'm sorry. No,
but
there's some of them are really smart people, but it's like this is my job, and they get it wrong as much as they get it right.
My sense of it is, and we did a few segments on this where we were as skeptical as we could, but we didn't know what, we don't know heads from tails, is that they were looking at history to say, like, historically, we've never avoided a recession in this kind of scenario. And you probably know better than I do. This is just my sense of the claims that people were making 2 years ago. And that was what they were basing their projections on, was that we've never been able to avoid a hard landing before. But it seems like where we are right now, to give credit to this current version of the Fed, and who knows, right? It's still early-ish, but a lot of people think now a lot of these projections are flipping to say like, oh, there's a high probability that we make it out of this with the so-called soft landing. And what they're trying to do, from what I understand, is they've got pretty low unemployment
Very low unemployment.
to get to this dual mandate that you talked about. So they want to at least preserve as much of that low unemployment as possible while getting inflation under control, which is a very difficult dance because, from what I understand, sometimes attacking one leads to problems for the other area. So, for instance, like raising interest rates to get inflation under control also means that the cost of borrowing goes up for companies, which means they may not hire as many people, right? Do I have that roughly correct?
Correct, which also means that the cost of Oreos goes up because the cost of them paying the interest on their debt, they need to make it somewhere.
Right. And so, but the general feeling is raising interest rates, even though the cost of those Oreos may go up, raising interest rates tends to decrease inflation, even if it creates higher costs in certain areas of life. Like, so for instance, if you're getting a mortgage, like if I got a mortgage a year ago, that may be the biggest cost in my life, right? That may dwarf what, the cost of gasoline or whatever is. But the sort of the conventional wisdom is that raising the rates, even if it may have certain inflationary effects in people's lives, by and large, it tends to decrease inflation. Is that right?
Yep. Absolutely. Raising rates is how you fight inflation. That's why when there was incredibly high inflation after the pandemic, why they raised rates fairly quickly. That's also why, and you mentioned there are a lot of people who think that rates were far too low in 2000 and frankly the whole 2010s. And the Fed would argue that they were coming off of the great financial crisis. I would say something we haven't talked about, which is really important, is that we are all both consumers and employers in our own way and investors in our own way. So the way that you think about or root for rates, so many people like root for rates to go down, but that isn't necessarily the best thing for you. If you are someone who saves a lot of money or you're a retiree on a fixed income, you actually sort of want a nice steady economy with high rates that pay you money on your savings. If you're a homeowner looking to buy and you happen to have cash or an inheritance, which is how many people buy their first home, you sort of actually want higher rates because the mortgage means less to you. If you're a real estate broker, you want rates to be 0%, always. That's why you see real estate people on TV constantly talking about how rates are too high, because that's sort of like the most direct. That's the easiest thing for people to understand, So it's complicated. It really is. Low rates are not all good and high rates are not all bad.
Well, let's talk about what this sort of likely era of lower rates that we're heading into right now means for the economy and for people. And you had a very helpful explainer in the New York Times about this. Let's go category by category. Let's start with stocks. You describe the phenomenon of what's called discounting and how rates affect discounting of stocks and stock market performance. You want to talk a little bit about this?
No, I mean, I'd like people to still listen to finish this podcast, so I don't want to get too far into discounting. But I will tell you the general rule of thumb is that when rates are low, that encourages companies to take more risks, to borrow more money, and to grow faster. And so that's good for stocks, right? So that's one thing. And part of that is how they value their businesses when rates are lower using discounting. It allows them to think their businesses are more valuable. Now, the flip side of that, which is really complicated, is that rates are only low when the Fed is a little worried about something, right? Because they're lowering rates to sort of boost the economy. So if you have a lot of money in stocks, you might be worried that rates are low because that indicates the Fed, who are really smart no matter what you think about them, that there's a reason why rates are super low. And if you look at the history of how stocks have reacted to low rates and high rates, you can find evidence for both ways.
Yeah, I was listening to this interview with Jeremy Grantham, who's like a sort of famous pessimist investor. And I kind of always listen to him for like the sort of the cold water take on things. And he made the claim basically to say, like, historically, when the rates, when they cut the rates, it often leads to a downturn in the market and often a recession. And I was listening to that claim and I was like, that sounds weird. And actually, when I was reading your piece, it kind of clicked for me, which is you have this line in your piece, which is it's not the act of cutting rates that tells you how the market is going to respond. It's the reason why they're cutting rates. And obviously, like, for instance, in the 2007 period of time in the early stages of the stock market, we were basically in a recession already when the Fed was cutting rates. So everything that kind of happened after it was really more a reflection of the rationale for cutting rates than the act of cutting rates itself. Whereas in other periods of time, cutting rates has preceded actually a bull market run, from what I understand.
And in this case, we can be fairly certain because the Fed has talked about it a lot. They're very concerned about inflation, and that although the rate of inflation has gone down a considerable amount, it's still up, and it's still higher than where they're historically comfortable. So we can be fairly certain that a big part of their reason why they're lowering rates is inflation.
Yep. So you then go to banks, like whether this is good or bad for banks, and it seems like it's a bit mixed, right? Because higher interest rates means there's a larger spread between what the banks can charge. There's like an arbitrage opportunity there, so banks can make money there. But at the same time, lower rates mean more mergers, more acquisitions, more IPOs, which are also a source of funding for banks. But by and large, the market reacts to lower rates by actually punishing bank stocks. Is that right? Like, bank stocks tend to go down when the rates go down?
Exactly. Since banks are going to lend out money at a higher rate than they charge you, than they give you an interest when you deposit, the higher the rates are, the more they can just take a little bit more of that, what they call a VIG, that difference. It just gives them a more breathing room there. But in a city like New York or San Francisco or Chicago, basically in any major city, the financial services industry, these investment bankers, they live on deals. They live on companies buying other companies. And that is fueled by debt. That's fueled by borrowing. So lower rates help those people. They help law firms. They help the catering companies that are delivering, those spreads of food to the analysts in the middle of the night who are working on these deals. It helps the bars who are serving them tequila shots at 3 a.m. when the deal closes. New York is a sort of special, and London, I would say, is so highly tied to not just what banks are doing, but particularly what investment banking is doing. So this is pretty good for cities like that.
And then, there's this sort of big part of this, which is businesses, right? Like corporations. And the sort of simple explanation of this is that the cost of borrowing goes down, which means they can expand, they can hire more people. It means that sometimes previous obligations that they have are cheaper. So, stocks tend to go up. But you also say that this is a little bit more complicated than people talk about it.
Yes, exactly. And by the way, companies taking on more debt is not always. I mean, anyone who's ever tried to manage their household knows that like just because you can put more in the credit card doesn't mean that was the right idea in the end. And I would actually add one thing that even wasn't in the piece, which is think about your city, your municipality, your town, which is borrowing money to build a new school or put a new bridge or something. Lower rates make it cheaper for them to issue bonds to do that. And that you could say is really positive, or you could say that it is layering more debt that eventually taxpayers will have to pay. I know this must be so frustrating for a listener because I just keep saying, hey, it's good and it's bad, but that's what makes the economy fun. And that's what, frankly, when you watch these presidential debates or these tweaks or like no matter Bill Maher, whatever your politics are, and I always go get crazy because I'm like, it's not that it's never just one thing. It's never like there's no magic here.
Yep. And obviously there's the effect on down the line people who are looking to purchase homes, et cetera. There's a Bloomberg article today, I don't know if you've seen it yet, where it talks about how there's a wave of refinancing already happening because of this, which is interesting. Because the decision to refinance or not is tricky in this environment because you're like, oh, do I wait another year when the rates are even lower? Because there is a cost of refi, like there's a fee involved, so you have to time it. This is what I think is so frustrating for listeners. It's like part of the difficulty is knowing when the right time to make a decision is, and often like getting it wrong is the most important financial decision you can make. Like it costs tens of thousands of dollars a year.
And yet I can tell you guaranteed that you don't know whether you're making the right decision. I don't know. No one can. Right. I can tell you confidently, but it won't be. It is maddening. And I would add one more thing. When you think about companies borrowing to expand their businesses, they hire new people, you get a new job. Those are the same people who would get laid off very quickly if things turned. Companies that merge, lay off employees more, for synergies. It's like, are you? It's just a genuine question to anyone who was listening. Like, would you be happy if your employer merged with another employer? I don't know, right? You might be. Maybe you got a big stock payout, or maybe you'd say, shit, like now they have two people in compliance.
Or whether they IPO, right? Like it's like how do you know? Now, okay. In focusing on the future, this gets to another article you wrote, which we'll have to do very quick work with, but you wrote another article a few weeks ago about, and we won't go into this, but like liquidity requirements and regulation on banks and how essentially like banks in the US have fought back effectively against various requirements and regulations, what are kind of colloquially called, I think, Basel II or whatever.
Maybe you are committed to making this the lowest rated podcast.
Yeah, no. But here's okay. Let me try to make it real for people. The European Central Bank has been way more aggressive with their financial institutions and trying to push them to be more transparent. Particularly, they're worried about the risk of commercial real estate holdings. And for people who are listening to this, you could see it with your own eyes. You go to your downtown, there are more vacant signs in commercial real estate than ever before. If somebody's holding those, owns those buildings and holding those, or waiting for lease payments that aren't arriving. And if you're like most cities, there's probably more for lease signs and windows than ever before. Europe is trying to be aggressive with this to force banks to be more transparent and write down those losses now because they view this as a systemic risk. From what I understand, the U.S. has been way less aggressive. And perhaps if we're trying to predict what the next recession could be, it could be related to this. It seems like a big risk within the system.
Most experts would tell you that there is a reckoning in commercial real estate that has not yet been, the jargon would be priced in. The banks and investors haven't yet admitted it. And you are correct that there's been these regulations potential regulations they've been debating literally since I was in college, that the banks that have started in Europe that finally maybe now will happen in the US. The problem here is that Basel III which, by the way, there was no Basel II. I don't believe they just skipped straight to 3.
No, there was. That's what we were
What?
debating. Yeah, when I was in college, when I was in law school, we were debating. It was 2007.
Oh,
Now we've truly lost. We've truly lost people on
Yeah,
this. But in 2007, I remember being in law school right before the financial crisis, and I had a class on financial markets. This is how I know this. There's some guy who taught it from Goldman Sachs who was involved in the Basel negotiations, and he was describing the liquidity requirements. And this is a self-serving explanation, but I was like a layperson listening to this and being like, man, it does seem like a good idea to require the banks to have like some minimum, like more money on their books, because it seemed like such a small amount of money we were requiring banks to hold. And lo and behold, obviously, we know what happened in the few years after that.
Basel is a really boring city in Switzerland.
Yes,
You should go to any other city in Switzerland, by the way.
Yeah.
If you're there. But
but this was Basel 1, 2, 3. Basel 1, I think, was 88 to 2007 and 3. But just the easiest way to understand it, listeners, each time the sort of cadre of sort of banking intelligentsia have ratcheted up the requirements of banks to hold capital, to be more transparent. Eventually that led to stress testing, Dodd-Frank, all this kind of stuff. By and large, what follows is some kind of regulatory action within countries. It's way more complicated than that because it's not always a one-to-one fit between what's decided at these conferences and what actually goes on the books in countries.
Essentially, the banks will argue, and there is controversy over whether this is a factual argument, that if you sort of require them to quote unquote take less risk, to hold more capital or basically money and not lend it out, that is a negative for the economy, that they can't lend out, they can't make mortgages, they can't provide credit cards or whatever you're looking to borrow money for. That's been their long-standing argument. If this latest Basel III, if it actually is enacted and it actually does crack down on activity, most people who watch this space say that the first type of activity that banks would crack down on is commercial real estate, because it's super risky right now. The thing that I think so many people ask, that I would listen to a whole podcast episode on, frankly, is, okay, we have all these buildings. They're in kind of cool cities or maybe lame cities. Why don't we just turn them into apartment buildings? We need a lot of housing.
We've done a few episodes on that with Brad Hargraves, who has a really good newsletter called Thesis Driven, and he's involved in the space too. He's actually had a startup that created co-living. So maybe we'll have him back on to get more into detail.
Let me complicate it for Brad here. Even if it works, and there's a lot of architectural zone, he knows it. I don't know all the experts. Let's say you did that would default those loans, because those are loans to commercial office buildings. You can't just switch them to residential. So that would itself create a whole domino effect of financial machinations that would affect the biggest banks in the country.
Yeah. So, in summary, if there is an equivalent of the credit default swap for this next period of time, maybe it's involved in something to do with commercial real estate.
For sure, that has not yet shaken out. So there are arguments. People will argue why it could not be the end of the world, but there are a heck of a lot of small and medium-sized banks which have a lot of their money, your depositor money, tied up in empty office buildings.
Yeah. Well, on that cheery note, Rob, we'll let you go. Plug away, starting with your wonderful book. And honestly, this is one of my favorite books I've read in years. I've recommended it to tons of people. It's why we even reached out to you in the first place. It is a riveting read. But where can folks find it?
Sure. It's called The Fund, Ray Dalio, Bridgewater Associates, and the Unraveling of a Wall Street Legend. It's a super fun read about basically a cult, in the world's biggest hedge fund, and this guy who just creates this whole make-believe persona around himself. You can buy it anywhere. I actually love the Audible version. I think the guy who read it is amazing. If you have read it, please write a review, because every day this billionaire hires people to write fake reviews about how terrible the book is. I'm
going to go do that actually right now. I just actually created a Goodreads account, so I'm going to go on Goodreads.
It's so important. Who knew?
Yeah, no, dude, I'm going to do it. I'm going to go do it now.
It's available in Italian and French, in Korean, 2 Chinese versions. Anyway, and the other thing I would say is I'm a finance reporter for the New York Times, and we aren't we don't have a perspective on things. We've generally tried to do it straightforward. I can tell you, I say this in every possible opportunity. There is no one who tells me what to write. I tell them what I think is up. And so, like, be a defender of journalism and of, you don't have to like everything about the Times or the Wall Street Journal, but like, it's just me. There's no Illuminati out there.
It's funny. Our audience, from what I can tell, has negative overall feelings about the New York Times, but they love the journalists that we have from the New York Times when they come on. So you're doing a service here. All right. Well, Rob, thank you very much.
Thank you for having me. Talk to you soon.